Hello, everyone. Welcome to our June Mortgage Quality and Compliance Committee webinar. We appreciate you tuning in and joining us this morning. My name is Samantha Gallagher, and I'm the Member Engagement Director here at the California MBA. If you have not joined us previously, we hold these webinars on a monthly basis, and we highlight a wide variety of compliance and quality assurance topics for the residential lending industry. If you are a member of the California MBA and you'd like to take part in our committee, that helps us decide on topics and speakers, please feel free to reach out to me and we can get you plugged in on all of that. And now I'd like to turn it over to our chair of our MQAC committee, Michael Steer, to kick us off. Thanks, Michael.
All right. Thanks, Sam. All right. Well, welcome to this month's MQAC webinar, Don't Get an F in Fraud. My name is Mike Steer, president of MQMAR, and I'm honored to serve as MQAC chair with our vice chair, Melissa Kopel, who is managing partner regulatory affairs at Loan Depot. We've got a full year of awesome webinars related to important audit, risk, compliance, and quality control topics. This month, school is in session with Professor Melissa and Professor Adam, as we have two super speakers dropping some knowledge about fraud, what to know, what to look for, real life examples, and what to do. And by the end of the webinar, you'll gain some practical tips and cheat sheets to become straight A students. Now, a little bit about the speakers. So I'll start with Melissa. So Melissa is the EVP, Head of Compliance at ActiveComply, a cloud-based RegTech software that allows financial institutions to monitor social media, websites, and remote workspaces for regulatory compliance and brand reputation protection. Melissa actively partners with financial institutions to develop and execute compliance policies and procedures based on institution size and risk tolerance levels. Melissa has acted as a content expert for the MBA, the Mortgage Collaborative, Housing Wire, MGIC, numerous state MBAs, and other financial industry groups and publications. Welcome, Melissa.
Thank you.
And we've got Adam Chaudhary. Adam is the president of Funding Shield, a risk management financial technology firm focused on wire and title fraud prevention, used on over $2.5 trillion in transactions to date. He's been an executive, investment banker, trader, and leadership team member at firms such as Goldman Sachs, Greenwich Capital, Royal Bank of Scotland, and others that have provided solutions to top global financial institutions, including private equity firms, hedge funds, asset managers, and banks globally. He's originated, structured, and delivered in excess of $50 billion in financing solutions, hedging solutions, and new products to the market. In his current role, he focuses on executing the strategy, operations, and client solutioning to drive Funding Shield's FinTech Inc. 5000 award-winning technology, where they protect mortgage lenders, investors, warehouse banks, and real estate participants from wire fraud, title fraud, and compliance risks. He's also the president of Pelican Point Investment Group, a boutique private investment firm and merchant bank located in Newport Beach, California. Now, before I hand it over to our amazing speakers, I thought I'd tell a dad joke in honor of Father's Day. Now, this joke isn't just any joke. It's actually related to our webinar topic about fraud, and worst case, you'll at least get a chuckle. So, Melissa Thomas, how did the cyber criminal escape?
They watched this webinar and learned all the ins and outs of compliance and how to navigate around them.
Great answer, but not correct. He ran somewhere. And on that note, let's get started. And by the way, feel free to submit questions in the questions box so that we can ask our speakers at the end of the presentation. Go ahead and take it away, Melissa and Adam. Thank you.
Sure. I love a good dad joke. I think that one of the things that's worth mentioning is we did promise a B+, I think, was our standard. Adam, you'd agree. And we don't want you to get an F in fraud, but we definitely want you to have an F in fun for this webinar today. Absolutely. And so we'll be having some chuckles along the way. So I wanted to start off by talking about some of the costs associated with mortgage fraud. And this is some statistics that came from a recent NMP December article where we know that fraud is definitely top of mind for the whole industry right now. We're definitely seeing a rise in it. So for every $1 lost to fraud, it costs about $4.23 just to address it. We can see some statistics around income fraud is up 27.3%, property fraud, ID fraud, transaction fraud is certainly on the climb as well. I know that Adam, that's certainly your area of expertise, and we'll be diving probably a little bit deeper into how some of those statistics are coming to be. For my piece of the webinar, I'm certainly going to be talking a little bit about the other types of fraud that are out there, so including data breaches, pre-employment fraud, brand impersonation, etc. As the folks at LexisNexis say in that article, businesses that don't embrace technology are going to be left behind. Fraudsters are definitely on the up and up, and they're learning how to leverage technology to be successful. We're going to be talking a little bit about that today as well, right, Adam?
Yeah, absolutely. And I think to that point, it's something that's been on our drumbeat for the last 5-6 years, as we've seen the technology proliferation and digitization of kind of the mortgage and real estate journey. And that kind of covers 3 swim lanes, as we always talk about it here, right? Mortgage lending on the financing side, the real estate on the purchase acquisition on the property side, and then the title side. All 3 of those kind of components that it takes to kind of get these transactions to close, especially in a purchase market for our core audience being mortgage lenders, are dealing with the fact that those digital tools create more endpoints and more entry points for bad actors to have knowledge of transactions that we'll talk about from different perspectives today. So I'm excited about this.
Yeah, absolutely. So maybe we'll kick off next talking about a recent case that was in the news, which some of you may have heard of. So sorry, next slide. We should have a keyword or some sort of buzz sound.
Ring a bell.
Right, ding, that'll be great. F is for fun, that'll be our code word. So one of the recent cases is most notably Freedom Mortgage. So it was made an announcement on May 22nd, not that long ago, that Freedom filed notice of a data breach with the Massachusetts Office of Consumer Affairs and Business Regulation. And for those of you who haven't had a chance to read through that fun announcement and article, the gist of it is that it was a cybersecurity incident through a vendor, the vendor being MIAC, which some of you may use or may know of, or maybe will avoid now. That being said, consumer names and social security numbers were part of that data breach. Social security numbers definitely brings up a step in the data breach parameters. Yeah. MIAC discovered the data security incident on April 6th. And you'll notice that there was information exchanged to Freedom on May 2nd. So there's a bit of a lag time participating there. MIAC sent out data breach letters to all impacted individuals offering free credit monitoring services. And that was as mandated by Freedom. I don't know if you've had a chance to look at this case, Adam, and maybe you have some insights to share.
Yeah, absolutely. I think there's a couple touch points here as we think about the general framework for the OCC third-party service provider requirements that came out in 2013. And then since then, basically every part of the FFIEC and from a regulatory perspective, as well as kind of every state banking commission has started thinking about the concept of vendor management requirements, third-party risk requirements. And if they don't have a specific provision, it's covered under the concept of data governance in terms of how do you manage certain data, classify data. And these are part of pretty much every vendor assessment that any service provider or even lender in today's market is sending out to their service providers. So I think a couple of parts of this are to think about, the takeaways that I see for our audience are, how do I think about this? Well, one, how are my vendors classifying data? How are they storing data? How are they storing data sitting on their databases as it pertains to different types of data? And what data do they have? And I think these are all questions we've heard in the past. And I think the challenge here is, you highlighted a couple of things in terms of where there might have been some pitfalls. One is, not to pick on MAIC, it's not fun to go through these incidents, but to your point, there is a little bit of a data lag. I think we have reps in our contracts that say if anything like this ever were to happen, we have a notification requirement within 24 hours, right? Because the second we become aware of it and it's confirmed, you have to disclose, right? And get ahead of it to kind of help prevent any leakage or further downstream impact. We did also see some of the larger lenders in the market send letters from Freddie that started this, where basically they want step-through rights on any security or data incident breaches, and having any seller. So for instance, if you are a vendor that provides services to a Freddie seller, Freddie wanted a tri-party agreement signed and executed. This was the top 10 IMBs that we worked with, pretty much consistently saw they wanted reps and a letter signed by us saying we would notify Freddie directly. That's even if 1% of the loans are non-impacted loans. So we obviously went back and forth with our regulatory counsel to kind of think about what does that mean as it pertains to our notification obligations, not because we had an issue notifying, but even if Freddie wasn't part of an impacted party, that was what our concern was. But we're starting to see these a little bit further reaching tentacles going down into the market in terms of real things that people are signing and putting out into the market without really understanding what the impact is on a bilateral or tri-party basis in terms of what that risk means, even disclosure.
God, that brings up such a great point that the root of this whole case, it was rooted in a vendor, right? And if you read through some of the materials, it wasn't really clear how it happened. It was somewhat mysterious based on that announcement and what was shared publicly, and made it really difficult if you're on the outside to try and diagnose, how do I address that with my current vendors? And if you are a financial institution, you have hundreds upon hundreds of vendors. And so it seems like a really daunting task. But I think that what's worth mentioning is that, not every vendor is built the same. Not all of them have the same levels of access to particular pieces of data. You should not be treating all of your vendors the same. You should not be checking in on your vendors the same. And that should be a big part of your vendor management process for sure, is grading them and making a severity level for sure.
Yeah, I agree.
So let's talk about, we don't have to go on to the next slide, but on this note, I do want to discuss on what goes into reporting. Adam, you brought up the OCC and some of the confines there, and you did touch on states as well. Many states required the disclosure of suspected data breaches. We can see here that this was particularly facilitated through Massachusetts. To have a better understanding of if you are ever in this scenario, the unlucky scenario as a lender where you have to disclose to somebody somewhere what has happened. Generally, the states are going to have some sort of form or submission process outlined on their website. They're going to tell you when it's a necessity and how often you have to follow up on it. They outline that really clearly most of the time. There's generally going to be a requirement that you also reach out and file separately with the Attorney General's office, which means you're managing two different lines of communication along with, if there's a vendor, how do you get them wrapped into that communication as well. Information requested in some of these submissions and notifications to Attorney Generals and the like is going to be the breach start date, when the breach ended, when did you discover the breach, the number of consumers impacted, types of data released, and like we noted, if social security numbers are included, that generally brings an impact of credit monitoring for consumers to be, and that's an expectation. What types of security members did you have implemented, both electronic and physical? And then the types of encryption that you have of your data. Maybe you can speak to also, Adam, what that looks like on your side.
Yeah, so I think a couple of things to think about, right? To your point is kind of how you're storing the data, right? Like a lot of the legacy, like there's probably two camps out there today in today's world, which is, and there's the on-prem guys, there's kind of the hybrid in terms of how they store their data, and then there's the cloud, right? Which is where a lot of folks have gone, even in the enterprise cloud. For some of the larger banks are starting to move that direction too. And we see those cloud transformation projects that started probably about 5-6 years ago for many organizations. Some are getting to it now to think about kind of how are they securing that data, once it's in their database, because that's typically, for most of these breaches we're talking about, it's obviously a cyber-based threat actor coming in, either hopefully they give the ransomware request first. I hate to say it that way, because they give an opportunity to kind of provide, not the release of that data, but in many cases, like they just release the data. Right? They're bad actors who want to get this in the dark web and share these credentials and other data points to be added as vectors for what will then become what we're going to talk about later: seller impersonation fraud, wire fraud, all these other sorts of fraud that these sort of data leaks contribute to. But I think to answer your point, data scrambling, with data at rest is something that you should have multiple firewalls, internal firewalls. Not just the external facing firewalls are important things to think about as well. And then to add to your communication kind of protocols, one of the things that we've seen with a couple lenders that have gone through this, that have reached out to us, that have had sort of data intrusion or fraud or cybersecurity based incidents, whether it was pertaining to a third party vendor or their own data, was coordinating that communication with authorities and also with your insurance carriers. And so that cyber insurance carrier communication dialogue is also very important. It's something that should be looked at right away with your counsel as well as your CFO, because they're going to have to start measuring what sort of financial impact it'll be to the organization, because it's not just your security team that needs to react to this. It's kind of a holistic effort across multiple parts of the organization.
And to that point, I think it's really easy for us to think that we're siloed in our departments. If I'm in compliance, I focus on RESPA Section 8, I'm looking for TILA issues and things of that nature. But it's important to note that as we become a more and more digital space and industry, Cybersecurity items are your problem. They are a compliance problem. You have to get educated on what is encryption, at rest, and what does that mean for me, and what are the standards that I hope to hold my vendors to, and things of that nature. So it's no longer this is IT's problem.
Yep.
You should be partnering with your IT department to get a really good understanding of where the biggest pitfalls are and how to avoid them, for sure.
Yeah, I think there needs to be an expectation amongst leadership teams, executives, and boards and board members themselves. And I think sometimes the boards are also at fault, even in the public space in the Fortune 500. There was a survey that came out by Gartner talking about the basic knowledge capacity of a typical board member of a Fortune 500 company when it comes to basic concepts of kind of a technology stack, what it means, technology security and cybersecurity. It's like less than 10 to 20% actually were able to have a conversation about it at any level of depth, even high level. And that's obviously gotten better over time. But I think it starts from the top, it starts with the executive team down. There needs to be an expectation amongst, the C-suite executives that, hey, this is something we're actually to have a discussion about. If we don't know what we're talking about, we need to get educated on it, especially when you think about the reliance we have to core processing systems, loan origination systems, strategic vendors as part of our day-to-day fulfillment and processes, like to your point, that maybe your lieutenants are executing, but there is a high level of correlation to a couple of service providers out there, to the extent that large banks make us treat some of these large tech providers like the Microsofts, the Azures, as subcontractors. They require us to look at them at that level and examine them in that way, which if you kind of understand that concept, we treat subcontractors a lot different, right? There's questions about who has badge access, where can they go in a building, how do they approve expenses, right? We have all those sort of thresholds and milestones and kind of processes that we put around, and gates we put around a subcontractor, and they're basically saying you need to do that with your cloud provider or your key strategic technology providers. And I think it's actually a good exercise that, looking back, was, oh my God, we got to do this. But now looking at it, it's actually a benefit because we have a better understanding of our relationship with those key strategic partners from a tech stack perspective for our operation here at Funding Shield, as well as being able to convey that to our clients, as well as people that are auditing us or doing diligences on our firm.
Right. Google Cloud has a SOC 2, report every year. Go take a peek and see what they're saying.
Right. All those fun ones, right? They should have their security center. Like Microsoft has that too. AWS, they all do, right? They're great resources, by the way.
Right. And I think it's difficult for everyone to be a technology expert. And that's not the expectation. That's not what we're professing here to be in any regard. But every member of your organization is a door into your data. You should have cybersecurity training for every single staff member. And I think that that's an expectation that a lot of lenders meet today. I have my cybersecurity training once a year. I've met my requirement. But to also know that particular members of your staff have more elevated access or maybe more high risk based on the nature of their role, and having additional courses can make for a stronger argument for cybersecurity protections, for sure.
And I also think you mentioned something earlier that I want to re-highlight, which is what's the cadence for evaluation, right? Certain parties, you execute it's a software provider, right? You use their software, they do an update maybe once a year, every 2 years. It's locked down, the passwords update, they have policies built in that meet your security parameters, and you have this ongoing relationship with them. That's one type of relationship. But then we have these other relationships where sensitive data, documentation, or information that's being leveraged in a very sensitive fashion is being used, such as brokers, such as appraisers, such as settlement title agents, which is what we deal with, where there's not this ongoing relationship over time, and there's also not this choice in many cases to choose that party. It might be the only person available, or maybe the broker's choosing it, or the LO's selecting that settlement title party. And so for that reason, you got to think about the cadence as to what frequency you're actually vetting those parties and on what metrics, right? It's not, like you said, one size fits all.
Right, risk-based. All of it should be risk-based, and it's not set it, forget it either. If things in contracts are evolving over time and expectations are evolving, so too should be your management process. So let's now transition maybe to our next case study. We'll be talking about a little bit of pre-employment screening. So as we all well know, financial institutions must perform extensive background checks to identify employment risks given the nature of the financial industry. And I think that many lenders and financial institutions are familiar with that and meet that on a daily basis. But at what point in the process does that background check take place? how early on, how far down have they gotten, when has access been granted to various systems and things, is not always a linear path as one might anticipate or might expect. So in this particular case study, there was a lender that had identified a developer candidate that they had strongly considered hiring. They had passed various development tests and exams as provided by a recruiter. They were offered to them by a recruiter. The provided information form for the candidate passed a preliminary background check. So providing key information like a social security number and things of that nature. However, upon completing some required home office inspections and some other information grabs, it was determined through specifically geolocation tracking that that candidate had stolen another identity from a real candidate who was indeed qualified out there and did pass the background check. And this candidate had stolen this information, and they were actually currently incarcerated. They had just been incarcerated. So this is a interesting scenario of timelines, which goes to say that just because you have information doesn't mean that somebody should be checking, should be passing the background check. It does go to speak to that you should be evaluating candidates. A lot of our work is done remotely, but you should be having some interaction with them beyond just through email. There should be phone calls or video calls implemented. Make sure that not only are they who they say they are, but also are they a good fit for your company culture? So having within your hiring process some parameters to prevent pre-employment, prevent pre-employment fraud through pre-employment screening, and adding those to your docket as well. Yeah. So this is an interesting scenario that could have been maybe a time saver earlier on before all that back and forth and all those tests that were submitted had some of these screening provisions been put into place earlier in the process. So let's take a look at maybe the next case study. Employee location fraud. So as we just talked about, a lot of employees work remotely. I work remotely. Me and my yoga pants are like this all day, every day. I'm about it. However, to give some background, businesses generally utilize VPNs to create secure connections and for locations to stay private. We know that VPNs are generally a requirement for loan officers who work remotely. It's part of a lot of cybersecurity parameters for ISPs, but also as requirements from a regulatory perspective. Yep. But in this particular case study, a lender had discovered that an employee had moved to Poland and had been working there for 7 months. And that was quite the lag time from the VPN. It was identified that they were utilizing their own VPN and not a company provided VPN, and that was a big part of the reason for the location discrepancy. It was only when they happened to have a random team meeting, hey, can you hop on real quick, that they noticed that it was dark outside due to time differences, and it was quite early in the morning there in Poland. And so they started to have some questions, and they did some checking with geolocation once again. So it's important to note that, IP address confirmation is not always the most accurate use case for identifying where your employees are. VPNs can be utilized, but VPNs issued by the lender are important, and how you're taking a look at that from an IT perspective is going to matter. And being aware of the other items that come into play if you were to allow the employee to work remotely in another country or anywhere. Maybe it was something that you were informed of, but keep in mind employment law, the scheduling of that employee, payroll, tax, and consumer data, security implications are still going to be at play even if you allow remote work. There are different types of fraud that could be happening in any one of those categories.
So I think what I'll go here, you covered it very well. I think some of the solution sets that we have, deployed are like, Microsoft Intune. You have joined devices that are locked down. You push your security patches and policies as well, like that kind of typical. That's kind of one way that we do it here. And I'll just give a personal anecdote. I was talking to our tech team that, my home office. I'm trying to connect a new keyboard or mouse, wireless mouse, and because it wasn't a registered device, it wouldn't work. Right, and so that was an example of, hey, this actually is really working. I was pretty impressed.
Wow.
Lo and behold, I was typing on my little laptop computer with my big fingers and chomping away a little slower than I would have liked to. But I mean, it just shows like there are solutions out there. They're not cost prohibitive solutions either. But yeah, I think you kind of covered the points really well. I don't have much more else to add to that one.
Yeah, I mean, we know that fraud extends beyond the financial transaction. It extends into your current employee base, your pre-employment base. Now let's talk about something that maybe is a little bit more public facing in our next case study. I just want to touch on social media impersonation. So Active Comply does monitor social media and websites for financial institutions, and we have seen incidences of social media impersonation. In this particular case study, a prominent lender had invested in what was known as an influencer division on social media. So that's where the lender takes resources and invests them in a particular division of loan officers and really supports them from a marketing standpoint on TikTok, on Instagram, and the like, to make sure that they're making use of these social media tools to the fullest extent. There was a focus for that lender on Instagram and TikTok, and they had reported successfully that over 25,000 leads were sourced monthly as a return on investment for that influencer division. And with that being noted, fraudsters also are aware of how prominent your influencers are on social media, and they're eager to capitalize on those just the same. So there was a fake account that had been created on Instagram. It had over 15,000 followers. To have a frame of reference, the real account had under 500 followers. So if you're a consumer, if you're a regular person and you're evaluating who is reaching out to you or anything of that nature, you're going to be looking at the follower count. You know, this is probably a fraudulent one because it's lower, it's not as prominent, it hasn't been around as long. Fraudsters are making use of social media. They can buy followers and they're investing because they know they're going to get a return on investment at the end of it. The fake account went so far as to copy every post that loan officer had posted and even responded to solicitations via DM. So they would have comments on those photos, the same advertisements that had the lender branding, and were soliciting, you know, PII from consumers through instant messenger. So one of the questions is, what is to be done? You should be having some sort of monitoring process in place that's out there looking for brand reputation issues like fraud. Is somebody using my name? Is somebody capitalizing on a trade name or a fictitious name? How do we go about getting that resolved with the social media platform? What are the processes for reporting it? If there was some sort of consumer data breach through that, how do we want to respond to that when it really wasn't necessarily, you know, us who had a hand in that type of fraud, but we could speak to what measures we were taking to try and prevent those types of scenarios and certainly prevent them in the future. So that's a really clear example of social media being out there and people capitalizing on your hard work and branding with the hope of gaining some social security numbers and funding and the like.
Yeah, I think this kind of translates into a couple of things. One is going to be my somewhat comical yet scary story. We'll talk a little bit later of my experience in Facebook Marketplace, which I'm sure some of the things you just mentioned play right into that, which will completely another segue for later, but really across the concept of digital identity. So it's a really big issue. It's been something that we see as a big driver of kind of how wire and title fraud are committed or laid out and actually performed and executed. And it has to do with social engineering. And part of that digital persona that people have and actually identity is social media presence, is what they put up there is one part of that. And so I think this is kind of spot on not just the side of someone impersonating you, but somebody impersonating your vendors, your third-party service providers. And this might be one way that they leverage legitimate photos, data, information, lifestyle based details that give you some level of comfort that you're actually dealing with someone legitimate, but you're not. And let's not even talk about the chat GPT, voice GPT, image GPT at this point, because all those can also be layered on top of that to create a very convincing layer of digital identity, where, like you said, you get on a phone call or communicate with someone, it's a little bit different. It's a little harder to generate that. I'm sure the technology exists and is out there,
right,
but it's a little harder for somebody to layer that on. Or of course to do it in person. So if they can do it in person, that's very, very impressive, vanilla sky all the way. But yeah, so I think from that perspective, I think it's important to understand what social media impersonation can mean against your own company, but also thinking about your supplier network, your trade partners, your borrowers, people you're trying to service and provide services to. That's kind of how I would segue into my part of the discussion on wire fraud later.
Right. I think to dust your hands of it and say that wasn't us, this isn't our problem, is not going to be a sentiment that's going to ring well for your consumer base, and they know that they have the ability to make use of platforms like social media or local news stations to outline what has happened. Brand reputation is certainly top of mind.
Oh, yeah.
I do want to touch on some other items that are related to social media where institutions, I just want to emphasize, don't make fraud easy for these fraudsters. So on a couple of different scenarios, we have found at Active Comply that corporate social media accounts, so for branches or for the corporate social media for the financial institution, they might have gone so far as to post training videos online, so on Vimeo or on YouTube, as a way to share it with other internal employees. What are the privacy settings on those videos? There have been quite a few occasions where maybe you have had a training team make use of Vimeo, they're in Encompass. That is not the test version of Encompass, that is real borrower data being exposed. And there are hundreds of videos that are being collected there. First of all, use the training version of Encompass. Let me just throw that out there with test data. But also make sure that your own content that you're putting out there has privacy settings that are applicable for your organization, or keep it within your OneDrive where you can send it to people internally, and that certainly makes the most sense. I would also like to point out that employees should be getting some insight and some lessons on how to best use social media in regards to protecting consumer data. There have been quite a few occurrences thanks to the pandemic where loan officers were working remotely, and here at Active Comply, we have OCR technology where we're looking at the images that are posted on social media, what kinds of words are being extracted from those images, things of that nature. And a very common scenario is, so happy to be working at ABC Mortgage, working at the beach house today, and a selfie is taken with the beach and a laptop screen where we see that really nice 1003. And if you zoom in enough, there's a borrower's social security number. So being aware that posting images on social media is a fine stance, or photos of you in your office is a fine sentiment. What is on your screen cannot be forgotten. Making sure that your employees have that as part of their cybersecurity training regularly will be paramount.
Absolutely.
So let's go ahead and head into maybe some more of the transactional fraud, some of the fraud that we're more used to maybe in our industry. My time working at a title company when I was fresh out of college, you definitely see fraud risk everywhere, and it's definitely top of mind for sure.
Yeah, so I think we talked a little bit about different flavors of fraud. We talked about kind of vendor risk as it pertains to fraud, but there's also kind of this designation between what's a service provider versus what's a vendor. And I think we talked about, some kind of organizations treat them the same and say, well, if I'm interacting with, a title company or an appraiser, I'm going to treat them and do a full vendor audit on them. Now, for most companies, that's not it's cost prohibitive to do it that way. It's too timely, and it doesn't fit the workflow and timing to actually get to a loan closing in time to meet the requirements and the deadlines that are put in place. So with that being said, what we like to think about is at Funding Shield is doing transaction level reviews. And we'll talk about a little bit about why we think that and why we think it's a better approach to kind of managing the fraud because of the fraud elements that are out in the market. But this report that we put together every quarter is published to our website, and it's based upon our live ecosystem of verified embedded settlement and title companies, but it's also based upon transaction-specific reviews. So this isn't just us saying, hey, here's 1,000 title companies, they're low, high, medium risk, and they're licensed or not licensed. That's not our approach. We're saying that those same 1,000 title companies were used on 25,000 closings. On those 25,000 closings, here are the issues we found with either the counterparty, the transaction detail and documentation, the actual transaction data between system of record and source data for the lender, which is your LOS, and source data for the title side, which is a title insurance underwriter system, which is where the actual full recourse obligation and policy will be issued from. And looking at that source data is how we kind of get in front of potential fraud, is not taking anyone's word for it, but verifying ourselves in real time on a live basis. So with that data, what we're able to do is amalgamate up to what level of transactions have issues, because basically our clients in the market cares about what's the experience of issues, errors, and potential higher risk elements that contribute to fraud, smell like fraud, or part of fraudulent transactions. And that doesn't mean all of these are fraud situations, but what it does mean is they're indicators of potential issues that need to be remediated, vetted, or kind of cleared as exceptions. So our data shows about 51.6% of transactions had elements or errors that would lead to potential fraud risk or heightened risk, or were issues or items that were needed to be cleared prior to close, according to a lender's own internal requirements. That's across resi lenders, that's across fix and flip business purpose lenders, and across small balance commercial lenders. One thing all those lenders have in common, despite regulatory oversight, is they are all required to have state banking licenses. And most of those state banking commissions and bureaus of real estate do require that they work with licensed and good standing title insurers, and they all have requirements from an underwriting perspective that they have to have either for their internal underwrite or for the investor buying the notes, a valid title policy issued by a good standing party, where there would be the expectation of recourse if there were a title file claimed, which I think is a pretty basic expectation for any originator in the market. So with that background, kind of breaking down some of the statistics, about 49% of transactions on the CPL basis, as an example, had issues pertaining to things like vesting not lining up, non-borrowing parties that were conveyed or listed to vesting, right? So those are pretty big issues that are going to have to be at best just cleaned up in post-closing trailing docs. Those are errors, or at worst are indications of parties being vested in a property they're not supposed to. That doesn't line up with the expectations what all the parties bringing the transaction to a close would like to see and are going to approve.
And that's quite a disparity compared to some of the other document error per transaction options down there. So CPL was definitely a point of focus, or should be, for
yes.
partners.
It's a proxy too, because you're talking about timing, right? Timeline, right? What are we getting ahead of a commitment? What are we getting ahead of the final policy? What are we getting to see as lenders if we're not going to do a full pre-closing title review, which most lenders don't do in the residential space because there's no time to do it and it's cost prohibitive, or if they are doing it, it's being done by some form of a cursory review at a very high level, very quickly prior to closing, and may not even be done on all transactions, or relying upon their closing instructions as well as the CPL, back to the CPL, to being accurate and saying, okay, yeah, that's fine. And what we do find is a lot of lenders aren't even checking the CPL. They're like, hey, it's in the file, it's good. So this is to tell you guys out there that are saying, oh, it's in the file, it's good. No, 49% of the time it's not. And these are not, this is a pretty diverse set of size of clients, type of clients, capital base of clients, and the types of clients that are investing in technology, some that are relying more upon us versus technology in terms of just saying, hey, you're our vendor, but we also relying you on compliance risk. Going down the line, 6% of the entities didn't have enough insurance coverage to meet the lender's requirements or had expired or lapsed insurance coverage. That's not a huge surprise, because every year we see the cost of insurance has gone up to the point where about 300% increase since the beginning of COVID today on typical professional liability policies. I think it's a reflection of the broader insurance market, and that we're in an environment, for all the reasons we just talked about up until this point, from social engineering to social media issues to data breaches to all those other external threat factors, that you now have to build policies and procedures around to confirm and validate that there was an omission of, an omission or an error against a policy that was actually laid out. Those are the reasons these costs are going up and up and up. But that being said, it's another indicator of who's qualifying versus who's not, and who really can afford to carry their additional levels of recourse in a market that is getting more challenging.
And can you use technology to create efficiencies, to save money, to pass on savings that are at the bottom line of that loan product? So yeah, those are certainly top of mind.
100%. And let's not forget these, insurance policies, when you're engaging with title and settlement parties, unless it's your refi or your direct to consumer where you have an existing ongoing vendor-like relationship with that title company, they're your preferred vendor provider, you may not have a additionally named insured kind of structure against an insurance policy. It's really the title insurer that's the beneficiary there. So again, it goes back to the left column at that CPL line, where you're really relying upon the fact that you're expecting to have some sort of coverage at a very high level against the Delta form of CPL that's being issued with every lender's title policy. And then going down the line, 7% of the wires that we touched were either for third parties not affiliated with the closing agent altogether, or for affiliates that weren't licensed in the jurisdiction of the actual state of close, or were for accounts pertaining to completely other parties that had nothing to do with real estate settlement. So they could have been personal accounts, it could have been other affiliated entities, other real estate entities, or in many cases, or just bad wire instructions for either fraudulent, closed accounts, shut down accounts that were subject to account takeover events. So in that situation, was it an error that somebody from the title company sent us the account that was shut down because of fraud, or was it because their emails were intercepted? Our goal is to say, hey, we don't care what the reason is. Our client needs to close tomorrow. We're not funding this account. Let's move
For the love of God, do not call or utilize the contact information that are on the wire instructions. You should be doing external validation of that wire instructions and not utilizing what could be a fraudulent wire instructions contact info.
Yes.
Keep that in mind.
So again, that brings a good question. We talk about source data. That's something that's really big and important to us at Funding Shield for A, our insurers that back us, and then B, for our workflows and processes to set the thresholds that we had established at NISMO when we certified our products and solutions. Was we said the only threshold of data that's acceptable is source data. And you hear about source data a lot as it pertains to D1C and income and asset. On that side of the house, we're trying to bring that same methodology and mindset and diligence and vigilance against data to the closing table. And so what we take about with Wire is there really is no data source that's as pure and as accurate as the depository institution that holds the account. They're the one that knows who actually owns that account or doesn't own that account. And so you mentioned phone callbacks and phone numbers. We went to the FBI 2 years ago when we started seeing voice over IP, kind of intrusion attacks, telephony hacks, right? Things that they hadn't heard about this in the real estate market. You hear about this in, kind of government espionage or other parts of the economy where frauds take place. But those same threat actors are coming into our market because they're not getting $1,000 credit card that they can go charge up. They're getting $350,000 wire that they can basically take out of that account, in addition to whatever other wires are coming into that account or that are supposed to be going to that settlement agent or escrow account. So there's a bigger person prize. And because of that bigger person prize, there's more sophisticated attacks being deployed with a very deep understanding of transaction details, who the parties are, what the property address is, what the workflow is, when do you ask for this document. There's a very, very high level of sophistication of these basically parties that are doing social engineering in many ways and impersonating parties, to your points earlier that you brought up on the employment side of the fraud.
Right. Now, I know that you also promised us some good fun related to Peloton and Facebook Marketplace.
Yeah,
I'm
absolutely.
super interested in this scenario.
Yeah, so I'll touch upon one last data metric here, and then we'll jump into kind of the segue there. But the last metric here is our CPL validation. So we actually go the system of title insurers to confirm source data to source data. And in 5.5% of the transactions at the time of close, we're talking 1 to 3 days prior to CTC, docs getting drawn, going hard, there was a mismatch, a voided transaction, or no title file order that corresponded. There's a whole host of reasons as to why that could happen. None of them are good or valid reasons. They really shouldn't be taking place. And because of that, we're able to get ahead of potentially very nefarious situations, or situations where somebody at the title company may have doctored up a Word document, PDF'd it, and fired it over, which they're not supposed to do. But in those situations, we're getting ahead of potential fraud and also making sure there's corresponding source data that represents your title file order from a title perspective relative to your loan closing. So these are really, again, source data attributes pulling directly, comparing, verifying in real time at the time of close associated to a loan. Now it's time for the fun. So F is for fun. Next slide, please.
Ooh, it worked. Yeah.
So I at the time of us putting together this this wonderful little webinar, us professors were talking about what was going on in our personal lives, and I mentioned that we're looking forward to the arrival of a baby girl in the next couple of weeks, and thank you. And as part of that, we're getting ready to make some space, and we're just we need more space. That's basically it. We need a double stroller. Where are we going to park it? Well, there's a Peloton right near this little nook in our entryway. Perfect location for a double stroller. So what do I have to do? Wife says, sell the Peloton. I go, okay, great. This isn't like selling something I can pop my trunk at a flea market and sell it on the back of my car. Somebody has to come to my house. Somebody has to spend a significant amount of money. How am I going to sell this? So sell it on Facebook Marketplace, one wise person says. So I list this bike on Facebook Marketplace, and within minutes, the world of fraudsters arrive at my digital doorstep. I thought it was so easy, right? Just place an ad.
Right.
Well, so your case studies before, I'm going to go a little professorial here. So why, how did I do this? Facebook Marketplace. Why? Needed more space for baby, AKA diaper money, hence the photos to the right. the impact. Who do I trust, right? So there's a guy there that's talking to me in the screen, but he's really reaching around trying to grab the money out of my back pocket. And so the question became, how do I enact cybersecurity protocols as well as physical security protocols? Because we got scammers, phishers, too good to accept offers. One guy offered me saying, hey, I'll give you 300 in cash, but a check for 1,500, which was more than I was asking for, which I thought was a little shady. What's going on with that check? What's going on there, right? And then the next thing was people were like, can I come by your house? I will come by right now. What's your address? Right. So now it's like there's all these things that when we talk about being ready from a cybersecurity perspective, I found myself having to take a lot of what we advise our clients, build in our workflows, and applying it to a very specific scenario in my own home. And long story short, not to go down the path of how I sold this bike, but I got lucky and fortunate enough to find someone I had a common connection with. It happened to be that person's head of HR at their company was my friend. And so I was able to vet their identity, but I still met them down the block away from my house at a bar, had a beer, spent 15 minutes chatting with him, understanding a little bit about who he was, getting a sense of who he was, texted my friend in a three-way text. He responded back. Then we went, sold a bike. Long story short, a little bit more diaper money, but clearly not enough.
This story is so funny because, at first glance, how does this relate to the webinar today? Where is the tie-in? And I think what stands out to me the most is the fact that you took a pause and you were like, this doesn't quite pass the smell test, and you saw how fast fraudsters were willing to contact you, and you, for your own personal protection, you did a lot of due diligence and you moved cautiously. And I think that if we adopt that same mentality about the businesses we work for, there's a lot less fraud that happens. And I think that very often we don't have that same sense of necessity for security. And it's very easy to get into the monotonous day-to-day of I go here, I check this, I do this, whatever, I'm good, it's not my problem. And if there was more of a sense of necessity for security and protection through each employee, there would be a lot less fraud happening in our institutions.
And literally every type of fraud you talked about, where social engineering, social media presence fraud, all those things are, I started literally looking through one buyer who actually looked legitimate. And I go through the pictures and all of a sudden I see this person one day is here in this country, the next day is in this other country, next day is this country. And I'm like thinking, hold on a second, they said that they live here and they don't, they didn't list that they traveled. And then I see all these random other profiles they're friends with to make it look like a more rich, realistic profile. And long story short, it was a fraudster, right? It's just luckily I did my diligence. Thank my wife for that. She's got a lot more social media skills than I do. I call her head of social media in her household. So she was able to help me do some of that diligence. I found a trusted advisor and I used her, but on we go. F is for fun for fraud. Next slide. F is for fun, not fraud.
You're right.
So long story short, here's an example of something that we saw earlier this year at Funding Shield. Long story short, it was a Utah-based title agent. And what we saw was the agent was issuing fraudulent title commitments to the lender. And the lender, unfortunately, this specific lender did not catch it. Our clients did catch it because of our protocols and review and our workflow. But what was happening is that this agent lost their active underwriter appointments to issue the title work. And this happened like on the third or fourth day of a month. They had about 10 to 15 open title file orders. The title insurer did notify the lenders who had open title file title file orders that this agent was no longer good, but the agent continued to issue fraudulent commitments that weren't registered in the system of the title insurer. Further, they didn't renew their license and to do business in the state. So there's another red flag that lenders should have probably been able to find within a couple days because they lost their licensing, they lost their appointments. And essentially, why did this lender lose money? Was they did not take the approach of the cadence of reviewing this agent on an ongoing basis. I think we forget as a mortgage community that our partners in other parts of the ecosystem and the broader ecosystem and housing finance industry are also going through this downturn and huge drawdown that they never expected to go through. And so in speaking with the top 5 lenders, head of title policy, their number one concern is solvency risk of these closing agents. Are they going to be here? Or are they not going to be here? And that's not necessarily cyber-based fraud. It's actually first-party fraud or risk that you're taking that you need to have a measurement in place for. And those same tactics of confirming licensing, good standing, are they still good today, even though I checked them a month ago, are part of what you need to do. You're sending $350,000 today on this loan. It's not good enough to say, well, a week ago I did. It's the same person, right? No, it's a specific loan. It's got a specific policy. It's a transaction-based risk. Because this lender did not do that, they unfortunately wired funds into this closing agent's escrow account. The closing agents used that money towards personal uses, stole the funds, wired the funds out. They're filing claims. Unfortunately, there was no legitimate title file order or CPL, as well as the agent was not in good standing. The agent took a the lender took a multi-million-dollar loss, and they have really no basis for filing a claim because a party wasn't licensed, it wasn't in good standing, and all those requirements, as we all know from a regulatory perspective, are placed on the lender. It's part of the lender's requirements to provide that level of diligence and review. Let alone forget about the actual consumer complaints are now facing as well, because the consumer's down payments were also defrauded in that workflow.
Right, and down below it, reputational damage to financial institutions, definitely a huge issue. On that note, when you're looking at some of these title providers, you should be evaluating just very quickly what's the most recent news out there. What's the consumer sentiment for this? You should be doing an evaluation of who you are doing business with as part of your due diligence process. It's not always easy to facilitate, but being able to utilize tools to do that would be a big part of the due diligence process, and to leverage technology as part of that.
Yep, and I think the other big one is no one made money in this transaction, even the people that were indirectly impacted, which people put work, time, money. Your underwriting staff goes through the process. We all know the cost to originate a loan and close a loan today. You're at the altar and you've spent the money. So beyond everything else, all the parties in the transaction are now out funds. So we have solutions around this. That's kind of what we shared in the data set prior that help get ahead of these risks, but you have to be conducting an ongoing diligence. And to be honest, technology makes it cheaper as well as cost effective to do that sort of level of diligence.
Well, somebody made some money. So somebody somewhere made that money, but no real supposed party within the transaction.
And in this case, title insurers did everything they were supposed to. They honored claims where they're actual legitimate claims. So like we had some clients that had closings that were in play prior to the actual issue going through, and title insurers will honor their claims. We're not here to pick on title companies or title agents. That's not our job at all. They're our trusted partners, and they do a very good job at executing that. So we just wanted to highlight that point too. So next slide, please. Thank you, Samantha.
F is for fun.
F is for fun. So here we go. We have this example now as home buyer purchase wire fraud. So now we're in a purchase market. We've got down payments again, and we have this thing called real estate agents and real estate partners, and everyone's looking to channel partner with your real estate agents and everything else like that. And it's a huge point of focus. But I think one of the things that we see now and we're starting to understand is that home buyers are very much left out of the picture from a fraud risk management perspective, both from the real estate side and especially from the lender side. And so what we have found is that more and more home buyers are getting their emails hacked and intruded because of obvious reasons. They're not using as secure email accounts. So there's some best practices we can provide after that and provide to our clients and customers. But long story short, there's so many parties that a home buyer may be interacting with as part of this closing process, right? There's a real estate side of the transaction. There's a lending side of the transaction, the LO or the LO assistant, and there's the title, settlement, and escrow side of the transaction. Sometimes the title and settlement's bifurcated, so they're dealing with multiple parties on that side of the actual workflow as well. So there's multiple people they could be expecting to receive information on where to send money. So this isn't earnest money. This is now I'm wiring my down payment into closing. Mm-hmm. That's where we see a tremendous amount of email compromise issues taking place, social engineering attacks. Add in the wonderful world of our chat GPT, voice GPT, people calling, impersonating, use the actual voices of people at that staff, at that location in escrow. And so there's a really big issue with protecting what we call the largest single cash movement a typical consumer will ever move in their life. Most people are not wiring $50,000 or $20,000 on a regular course of their day-to-day lives. So they're not knowledgeable in the process. They're being warned by everyone, and no one's giving them tools to actually verify information. And so what we think is needed here is really hand-holding, engagement, education's a good start. Mm-hmm. But when that money doesn't go to closing, same issue and same impact as our previous slide and example. There is no closing. You can't close without the wired funds coming from closing and coming from the home buyer. And so a couple of our clients, prior to deploying some solutions that we put to market late last year and have been growing this year early as channel partners with lenders and real estate agents that protect and guide the home buyer, were actually writing checks just because they didn't want to deal with reputational risk. It would cost them $15,000 to $20,000 to deal with just legal claims alone, lawsuits. Or like, I might as well just spend another $5,000 and keep a home buyer happy and let them know I'm taking care of this relationship. And this was not being done on onesies, twosies basis. It was being done across multiple lenders who are saying that risk cost benefit analysis resulted in them just saying, write the check. Let's just not deal with this. This is going to become a nightmare. And it's because the home buyer is being advised to sue everyone. Sue their depository institution where their monies are held. Sue the lender who's actually providing the loan, whether it's their depository institution or not. Sue the title company, right? Sue the real estate agent. Sue everyone. How come no one protected me? Now, the existence of recourse may be limited, but the nuisance, the reputational risk that we talk about are surrounding that, as well as the lack of customer experience. We're all dying and spending money to get these kind of relationships for life, which is kind of the whole thing we hear in the technology market is how do we capture the loan relationship for life from this consumer? This is one way to lose it for life, 100% guaranteed. Anything you want to add here on this one?
I think that you touched on it really lightly, that educating your home buyers where you can and making efforts is going to be paramount. Having email footer items and notes about wire fraud is not enough. Who looks at an email footer? Hardly ever, unless they really need your phone number, right? So making sure that that's a big part of your loan origination process. And then I would say that when I've worked at financial institutions in the past, something that's been really successful is doing an internal audit process where you're sending out those fake wires. Are they accessing the links? Yep. Having your IT department have those statistics, having mandatory trainings based on some of those findings, and then also having rewards for those who are successful. At my last institution that I was at, I had reported enough to IT that they sent me a t-shirt with big bold text threat detector. So like having fun cybersecurity benefits also as part of your process can lead to a better cybersecurity, I think, environment at your institution for sure.
Absolutely. And I think the one thing that we hear, you're going to start hearing more about it, especially the bank-based lenders are going to start pushing this thing called Fed Now. And so this is the Federal Reserve's system to provide basically a broader and more kind of 24/7 like settlement system for wires between participating banks so that you don't have to wire during kind of bank availability hours or bank hours. It's got a lot of potential benefits in terms of creating more flexibility, extending the settlement timeline and making more days available and timelines available to when our consumers actually pick up the phone and talk to us, which is after work, to actually have a settlement go through. But it also opens up even more for fraud and risk because now you're dealing with a consumer who doesn't know much about the process, who's being asked to do something in the middle of the night with a high sense of urgency, which is exactly what every fraud scheme looks like. Hey, do it right now. It's Saturday. Just get it done with. Just get it over with. Not wait till Monday, call my office and confirm and verify. So we're going to have to really put some rails around our behavior expectations and training the consumer and educating them more, which is part of what Funding Shield does for the consumer B2B2C offering we have called Buyer Shield. But we also provide a mobile immersive workflow to give the tool in the consumer's hand, like not too dissimilar to Active Comply. You give the tool to protect the client, not just educate them. And that's where the technology offering comes into play.
So true. And I know we're just about at time. I think we've got one more slide left.
Yeah. I know maybe we can we can put on the screen. I know we're about to come up to time, so I'm happy to cut off or end here. But I'll just spend a quick 10 seconds on it. One of the big rising areas of fraud on the real estate and title side that everyone in the lending community needs to be aware of is called seller impersonation fraud. So a lot of times it's a vacant lot. Sometimes it's a person that's taken the identity of a legitimate seller and is looking to sell the property. All the same metrics we mentioned earlier are important for your partners to be taking advantage of, which is have physical communication and discussion, dialogue, meet the parties, at least do online videos and conferences with those parties, do the same level of diligence you'd expect to do on the seller's identity that you would do on other parties to the transaction. And also maybe use verification procedures like, hey, where do you want the money sent? confirm and verify that that bank account where the money is to be sent actually is owned by that actual seller and not. And that's another metric and solution that we've actually launched now for our partners in the real estate and settlement communities as well.
That was fun. Big F.
Big effort.
Big F for fun.
And an F for fun, right?
Yeah, so I mean, really great information, a lot of practical tips. I think one quote I wrote down from you, Melissa, was every member of your team is a door into your company's data. And I wanted to expand on that and say, hey, teach your employees how to be a wall, not a door, and hopefully the great wall to keep the bad actors from getting into the company's data or committing fraud, because at the end of the day, if the company has fraud incidences, it obviously costs money, which in turn hurts the organization and their inability to be profitable, continue to invest in the organization or even in the employees. So be a wall, not a door.
Be a wall, not a door, so true.
Be a wall. Well, just want to thank both of you for joining us today. It was awesome. A lot of information, a lot of key takeaways. And if anybody has any questions, they can reach out to Melissa or Adam. This webinar is being recorded. It will be posted on the California MBA's NQUAC landing page on the website. And I don't know, Sam, anything else?
You nailed it. That's perfect. Thank you, Adam and Melissa, for your guys' time.
Yeah.
On point,
Thanks for everybody tuning in. We appreciate it.
Absolutely. Thank you for the members who joined in and heard us. You can reach out to us directly. Our contact information. I'm sure Sam can make it available if they have questions.
Yeah, absolutely.
Thanks,
everybody.
Have a great day.
Thanks, everybody.